coming to the last topic of today's Prelims pointer, which talks about your IPOs in capital market or stock market. So it relates to the economy section of capital markets, which is also called stock market. So what this article says that because of the turbulence in stock market, because the market is falling a lot, a kind of bear market is approaching in the Indian capital market. Now a lot of IPOs are being deferred because in this type of condition, these IPOs do not get good valuation. Earlier, let's say they can list their company in IPO by valuing a company, let's say at 1000 crores. Now they will just get 600 700 crore valuation because of the market dynamics. So a lot of IPOs are being delayed. One famous IPO is for PhonePe, which a lot of we people use PhonePe for digital payments, UPI payments. They have filed an IPO for 13 to 14,000 crores, which has been delayed. So basically, this article entirely talks about how, because of Iran-Israel war, because of volatility in the market, because of higher crude oil prices, falling rupee, all these factors, the markets are not in a stable form, and because of it, a lot of IPOs are being deferred. Now, why it is important for us? Because UPSC asks a lot of questions these days from stock market. They ask technical terms from the market. So what you have to keep in mind here is IPO. We'll see about what an IPO is, what are the different terms related to IPO are. So what is IPO? It is an initial public offering, initial, for the first time when a private company offers share to the public through stock exchange. Now what it does, let's say a company wants to raise money to expand its factory. Now they do not have so much of profit. Let's say a company earns just 50 crore of profit, but they require 200 crores to expand their business, but they are not willing to take loan from bank. What they can do, they can sell 10, 15, 20% of their stake and get money through it. Whenever some stake will be sold, they will get that money. That money will be used for expansion purposes by the bank. So the ownership of owner of that company, earlier let's say a person was having 100% ownership of the company, now he'll be having 70-80% of ownership. He sold his 20-30% stake, but when it is sold for the first time, it is IPO. Company becomes publicly listed on stock exchanges like Bombay Stock Exchange and National Stock Exchange. Clear? What is the purpose of IPO? To raise capital for expansion of business, to reduce debt. Let's say they have taken some loan from the bank, but now they are not generating that much profit. Otherwise, they would have repaid the loan by profit. So they require a stake sale to repay the debt. Then new project they must be launching. For that, they require money. So, or it is also done for providing exit route to the early investor. Let's say somebody, for example, your Shark Tank investor, these are early investors. Somebody is investing, a venture capitalist, an angel investor, a seed capitalist, or a private equity firm. They provide early stage money to these startups. Now, when they become large, they have to sell their stake and take their money, and they will use that money somewhere else to fund some other startup. So they require an exit. So these VCs or private equity firm, they sell their stake in the stock exchange, which is bought by either mutual fund houses or institutional investors or retail investors. Or they are also used to improve the visibility and credibility of a company. If a company is listed in stock market, its visibility increases. People come to know about that company. Their sale of their products increases because of the increased visibility. If say a lot of people are discussing about your company on a national TV because it is listed in stock exchange, so it is a kind of free PR for that company, free advertisement of that company. Who regulates all this? SEBI. Now here there is no role of RBI. SEBI regulates the IPO mechanism. There are different kinds of stake sale in IPO. First is your fresh issue, where new shares are issued and money goes to the company. Company issues new share, the old share gets diluted, and in the fresh issue, what happens? Whatever stake sale happens, whatever money is collected, it comes into the company. And in this fresh issue, the capital comes here for expansion, debt reduction, and new projects. The other part is offer for sale. In offer for sale, what happens? Existing shareholders, they sell their shares, and money goes to the selling shareholder. Now these selling shareholders, they can also be promoters. Promoters means owners of the business, or they can be private equity or venture capitalist firm. Clear? Or any other investor. So this money offer for sale goes to this to provide exit to somebody else. Now, what is the pricing method in IPO? Who decides the price? How it is decided? There are two methods. One is fixed price issue. Price is decided in advance that let's say this IPO will come at a price of 100, and whosoever has to buy will buy at 100. Another is book building process. Largely, most of the IPOs today come through book building process, where they will give a band. The price discovery happens through bidding, where a price band is provided, a floor price and a cap price. Floor price, let's say, a price is given between 100 to 120. If the demand is low, the IPO will be sold at 100 rupees. If the demand is very high, it exceeds more than what was required, it will be sold at a cap, at a higher price of 120. So demand supply decides through bidding, decides this price. So book building process is used these days. What are the other key terms? Your draft red herring prospectus, DRHP. What is DRHP? Basically, it is submitted to SEBI before an IPO approval by the company. Company tells all its details in its DRHP, so that the investors who has to invest in that company, they can read about that company, they can know about that company, because earlier this was a private company. We do not have any information. Later on it will become public, we will have a lot of information, because they'll have to publish annual reports every year. But right now we are not having. So through DHRP, we gain information about these companies. So DHRP is draft, just like a draft bill. They are filed initially. At the final stage of IPO, they file RHP, Red Herring Prospectus. Red Herring Prospectus is a final document without final price. So they have all the details about the company, but not the final price of the issue. Now, why it is called Red Herring? Somebody must be curious why it is called Red Herring Prospectus. Because see, whenever a promoter sells something, they will always tell the good things about that company, that this will gain this much of revenue, this much of profit, itni badhiya company, all those things. But through this DHRP, we get to know about the you can say shortcomings in the company, limitations about the company. And these limitations can be in the form of, let's say, some company is loss making. A company promoter or owner can have a litigation against him, a court case against him. There may be a previous income tax raid on that company. All these things are given in red herring prospectus. That's why it is called red herring prospectus, so that red is the color of danger. So it, you can say, tells people what can go wrong here. Clear? Apart from this, what you need to know, what are the category of investors? First is QIB, qualified institutional buyers. Generally 50% of the quota of IPO is kept for them. These are large institutions like your mutual fund houses who buy stake. Apart from this, 15% of share is generally kept for non-institutional investors. These are largely your HNI, small HNI, high net worth individuals, and big HNI, big high net worth individuals. Largely, they put in a bids worth around 2 lakh, and big HNI put bid worth around 10 lakh. And then in last, we have retail investor. For them, 35% quota is kept. Retail investors generally like us people, so they can invest up to 2 lakh, but generally they put 15,000 in IPO application. So these are different kind of investors. QIB, large houses, business houses or mutual fund houses. NII, your high net worth individuals, and retail are people like you and me. What are the risks in IPO? Now, DHRP talks about these risks. For example, these companies have no historical market performance because they are new. They are coming for the first time in the market. Then overvaluation risk might be there. Some companies, for example, your Tata Technologies is a Tata company, which is an IT firm of Tata. It was listed at 1400, and right now it is, after 3 years of listing, it is still at 700 rupees. So whosoever has bought at 1400, in 3 years they have not gained anything. In fact, their wealth became half. So overvaluation risks are also there. Then market volatility, times like these, they can create a large gap in the price. They can make a company undervalued also, they can make a company overvalued also. And information gap, because we do not know a lot of things about the company. This is a new company, so it is always a risk. Now, what are the exam traps here? What you have to keep in mind with regard to prelims? Now, IPO means government selling shares? No, not only this. Although if a government is also selling stake in PSU, that is also an IPO, but not only government. Fine. Then only profitable companies can launch IPO. Again, this is wrong. Companies like Zomato, they are loss making, they came out with IPO. Companies like Policy Bazaar, they were loss making when they came out with IPO. Companies like Urban Company, they were loss making. So a lot of loss making comes in for IPO. They can also stake sale. In future, they can become profitable or whatever happens, but initially this is not a requirement that they should be profitable. Then IPO price is always fixed. This is again wrong. Price may be determined because of the bidding system. And last, SEBI issues share. No, this is wrong. SEBI regulates the entire system. SEBI oversees this process, but SEBI does not issue the shares. Clear? So these things you have to keep in mind regarding